What is up, everyone? Welcome to Investing Club. In this video, I'm going to talk about 3 gold stocks that I think have the potential to do very well going forward and why this could be a good place to start buying. Before I get into this video, this is not financial advice. I am not a financial advisor, and you must always do your own research before buying a stock and know that there is risk with any investment. So first, let's talk about why I think gold stocks have the potential to do very well. If we take a look at the historical chart of gold prices, in the past couple of years, the price of gold has skyrocketed, and we are almost at the highs we saw back in 2010 to 2012, and I expect us fully to get there. One of the main reasons I think that gold has the potential to go up in price is because of a lot of the policies of the Federal Reserve, all of the money printing that we've seen going on. We've seen a huge increase in the money supply, and when that happens, I think metals like gold are things that store value very well. And I think the more money we have in circulation, the higher the price in gold should go. And when you think gold's going to do well, who are the people that stand to gain the most from an increase in gold prices? And that is gold companies. Companies that produce gold are the ones that benefit a lot from this increase in the price of gold. And so in this video, we're going to take a look at 3 of these companies that produce gold, and I'm going to talk about why I think they are a good value. So now let's talk about the 3 gold stocks I think could be a good buy today. The first stock is Iamgold Corporation, ticker IAG, and this is a Canadian gold company. So there's a couple things I like about this company. Mainly, it's just how undervalued the company looks. Their price to free cash flow is around a 5, which is very attractive in today's environment. They currently don't pay a dividend, which is different than most gold stocks. Most gold stocks do pay some sort of dividend, but this one does not. Over the next 5 years, their earnings are expected to grow 21%. So like most gold companies, we're going to see an increase in earnings and cash flows from these gold companies as the price of gold continues to go up. For every dollar their share price is, they almost have 50 cents of cash. They have 174 in cash per share, and the share price is under $4. So that's a good thing. This company is in a very healthy position. Debt to equity is only a 0.2. So again, this company is very conservative. Their current ratio is a 4. So this company should have no problem paying off its debt and really making it through any difficulties that may come in the future as a result of more economic problems coming in the next few months or years. Obviously, when gold was higher back in 2010, 2011, the stock price was higher. This used to be a stock that was over $20. Right now it's under 4. And the stock hasn't really been doing anything for the last 4 to 5 years. And that's the same with most gold companies since the price of gold tanked for a while. But now if we see a new bull market for gold, I think it's reasonable to see this company get back to over $10. I think that could be a place where this stock could go to. All right, the second stock is Agnico Eagle Mines Limited. Their ticker is AEM, and this is another Canadian gold mining company. Now, the thing I like best about this company is their earnings growth going forward. This company generated $1.73 in earnings per share over the past 12 months. So they are a company that is generating a lot of earnings. And over the next 5 years, their earnings are expected to grow at 30%. So it's a very fast growing gold company, which you don't see a lot of them growing as fast as this one. Now, that being said, their PE ratio is sort of high. It's at a 36. So that is a little expensive for a stock like this. Back in March, we saw this company trading around $30, and right now they've almost doubled and they're over 60. So if we see this company get down to that $40 to $50 range, I think that could be a very good buying point for this company. They have a market cap of 15 billion, so they are pretty good size. They're not as small as the last gold company we just talked about, and they have pretty good margins. Their gross margin is 49% and their operating margin is 32%. And their debt situation looks okay. And in their earnings call for Q1 2020, their management team said they're focused on free cash flow generation, and they're really focusing on reducing their capex numbers, and they're very confident in maintaining their dividend. And again, for the second half of this year, their free cash flow is going to look very good. So for that reason, this stock is a very interesting buy. Another thing I want to look at is their valuation. So right now we're on Fastcraft, and this is their operating cash flow. A lot of gold stocks aren't valued based on their normal price to earnings. You have to look at some different numbers. And this company is usually valued based on its operating cash flow. The black line, which is the price, really moves in relation to what their operating cash flow does. Ever since around 2010, we've seen it move pretty consistently. And over the next couple of years, we're expected to see a huge jump in operating cash flow. And so that could result in the share price following. In 2021, it's expected to be $140. And right now, the stock is at 88. And this is in Canadian dollars, since this is the version of the stock on the Toronto Stock Exchange. So if you think that that's the amount of cash that this company is going to generate, then it is reasonable to think that this company could go up 70 to 80% over the next year. And their dividend is also very safe. Just looking at this year, their dividend payout in terms of their operating cash flow, their dividend's only 18% of their operating cash flow. So that is a very conservative number, and I don't expect them to cut the dividend, and they said that themselves in their earnings call. So overall, this looks like a very solid company. Their cash flow is growing consistently. If you take a look over the long-term chart, their operating cash flow has just been going up steadily, and that's something I really like to see, especially with companies like gold that are normally cyclical. It's good to see some sort of consistency in their operating growth. All right, and the last company is Altius Minerals. They're listed on the Toronto Stock Exchange. They're a Canadian company, but they're also traded over the counter in the US. The ticker is ATUSF for US markets. And this is a company, it's not gold, but they produce a lot of different metals such as copper, lithium, nickel, cobalt, and more. And they are a royalty company. So this company holds diversified royalties and streams and generate revenue from 15 operating mines. So they own the mines and they generate royalties based on what the mines produce. And from this chart, you can see the royalty revenue has been exploding since 2014. And this is probably the stock I'm most interested in out of the three, just because I like the royalty business model. This company can make huge margins because all they do is they own the mine. Someone else does all the work with actually building the infrastructure and doing the process to mine all the gold, and then this company just gets paid for owning the mines. So we'll take a look at their margins, but that is something to know. That's why this company is different than the other typical gold mining companies. This company doesn't actually mine the gold themselves. They own the mines and then let other companies mine it and then just make a royalty off of those mines, which I really like. This company has also been very consistent. This is their EBITDA per share, and since 2014, again, it's been consistently growing, even though the price of gold and a lot of other metals that this company owns mines to haven't been increasing in price. They're still able to increase their EBITDA. So like I said, this company has huge margins. Over the past 12 months, their gross margins are a huge 91%. And that's the benefit of being a royalty company, where you don't actually have to do the work yourself. You just own the mines and then receive the royalties. Their profit margin over the past 12 months is 14%. And again, that has taken a hit due to the economy we're in right now. But their annual profit margin is normally around 30%. And their operating margin is 35%, and in the past 12 months it's 31%. So this company makes huge margins, which is something I really like to see when looking for companies. And this company also has a very good management team. The return on equity is 5.4%, which is very good for a gold company. And this management team has a history of taking advantage of rough economic conditions like we're in now to grow their business. So back in 2014, 2015, when the price of a lot of metals were down, this company invested heavily in finding different mines, in lead generation for these mines, where a lot of them were being sold for cheap because of the price of these metals were depressed. This company realized it was a good time to be buying these mines, and so they invested a lot back then, and now they're seeing the reward of that as the price of these metals start to go back up. So that's something I like about this management team. So on this chart, again, we're looking at the cash flow, and something I like about this company is the dividend. They recently started paying a dividend in 2015, and right now it's only around 30% of their operating cash flow. And so that is a pretty conservative number, and they're probably not going to cut their dividend. And their operating cash flow is only expected to increase over the next few years. If we take a look at their performance, the carried average growth rate of their dividend since it started has been 75%. And I think this company still has the potential to grow their dividend at a very fast rate like this. The dividend started at 2 cents a share, and it's already at 19 cents, expected to be 20 cents this year. So this dividend has gone up by 10 times in 4 years. And I think we have the potential to maybe see that again. I think this is a company that would make an outstanding long-term hold, where if you just bought this company now and waited 20 to 30 years, this could be one of those stories where the dividend every year makes you more money than your initial investment. And so I might start a position in this company. I'm looking at it pretty closely, and I like what I see so far. So those are the 3 gold stocks that I'm talking about in this video. Let me know what you think of them. I'm interested to hear this. Leave a comment what you think will do better over the next year, gold or Bitcoin. I'm interested to hear what you have to say. I think they'll both do very well. I'm not sure which one will do better though. So let me know what you think in the comments. And if you like these stock picks and this information, leave a thumbs up on this video, subscribe to the channel if you haven't already, and I'll see you on the next video.